Hello students, here is the Dr. Wang recording, and we continue on chapter 1, which is related with the basic introduction of accounting as a profession and also as a academic subject. And now we're going to cover the basic principle that is utilized in this accounting profession. It is called Generally Accepted Accounting Principles, aka GAAP. And this is the most fundamental and widely accepted world accounting principle. It's mainly used in the United States. And so basically in the US, we all use GAAP to do accounting. So we also use this accounting principle for several different aspects of financial services as well. So what is our goal here to use a GAAP? Well, we want to use GAAP to convey relevant information to our users. As I defined earlier, that our users could be external, could also be internal. And the information we make should be related with the operating performance of the company. It should also be reliable and truthful because it has to be free of human errors and mistakes, and also free of accounting fraud. It is should also be comparable because we want to compare our financial information for this company with another company to see which company is better for us to invest in. So the basic requirement here is the information needs to be relevant, reliable, and comparable in summary. All right, and there also exist other accounting principles that are used outside the United States. So these international standards could be International Accounting Standards Board, and also International Financial Reporting Standards, aka IFRS. So these are also used by many countries. The thing is, the difference between the US GAAP and IFRS are decreasing, and basically it says the differences would be very little now, and it's more similar from one to another. And nowadays the trend is for the FASB and also IASB and also GAAP to converge to reach the single set of international accounting standard. So here the conceptual work. The FASB and IASB are attempting to converge and enhance the conceptual framework, which helps you to understand the accountings. So you should know that on the top of the pyramid is the objectives to provide useful information to investors, creditors, and others. So the investors would be debt investors and also equity investors, and the creditors could be long-term debt holders or short-term debt holders. So qualitative characteristics is to acquire information that is relevant, reliable, and comparable, as I mentioned in the GAAP principle. The elements here are the items that financial statements can contain. So we have revenue, expenses, assets, liabilities, and equity. And each of these components could be further divided into individual elements. So for more details, we will cover in later chapters. And also we need to study recognition and measurement. These basically set criteria for an item that you should meet is as an element, and how to measure that element. Do we use dollar signs, or do we use a percentage, or do we use something else? So the principles and assumption of accounting under the general they accepted a accounting principle, okay, or GAAP. We have different principles such as a measurement principle, which enable us to measure different variables, and they should be measured on a numerical basis. and also a full disclosure principle. Basically means the accounting number and all this information should be disclosed and released to the users. And also revenue recognition and expense recognition. Basically, it means we will put the number in when revenue is recognized or when the service we provide is rendered. And we put the number in for expenses whenever the expense is incurred or we have already purchased the deal. Well, the thing is, it looks pretty obvious, right? The revenue is recognized when it is earned. The expense is recognized when it is incurred. The thing is, in modern days, many of the businesses are conducted on credit, which means the payment is not 100% in cash. So you may sell your service to somebody, but you don't get your payment 100% in cash today. You may get half of it in cash, and the other half would be account receivable. You will collect in the future. All right. The thing is, when you make $100 sale today, you just put $100 in your accounting book. Okay. The only difference here is that you do not put $100 cash in your accounting book. Instead, it's a $50 cash and a $50 account receivable. Although that account receivable has not been collected yet, we still recognize it as part of revenue. And the same story for the expense recognition. We may not have paid all the money to our seller. So let's say you have purchased a car from a car seller, that's an expense to you, and you do not pay 100% yet today. You'll probably pay 50% in cash to the seller, and then you pay another 50% in the future. And today, that expense is recognized as account payable. So on the income statement and on the balance sheet, you will have the full 100% expense recorded there, but you don't put everything here in cash. Instead, you just put 50% in cash and 50% in account payable. So that is the recognition methodology in GAAP. And you also have different assumptions, which are going concerns, monetary unit, time period, and business entity. And we are going to introduce a lot about the business entities in the United States. And of course, we will apply, we will use money or dollar figure to measure the accounting item, and we will apply a certain time period, whether it's happening in a quarter or in a year. And also we will study the items that actually concern the daily operation of the firm. And also there's constraints applied to this GAAP. The materiality, everything needs to be in paper and materialized, and also the benefits has to be greater than cost when we're running our operations. And this general principle would apply for the long term, and when we combine the assumptions and concepts, principles, and so on. And that is a very maturely developed accounting rule that people can use. Now, let's talk about the general type of businesses in the United States. Actually, there are four major characteristics. One is proprietorship, and another is a partnership, corporation. The third, the textbook did not mention, is called a limited liability partnership or limited liability company, LLP or LLC. Okay. The thing is, the textbook just put it LLC here as part of the partnership, but it's a little bit different than a partnership. So just follow the textbook. So let me just say the partnership and LLCs are put it right here. Okay. So what are the attributes for this kind of businesses? So the sole partnership basically is a business run by one person, right? So this is run by one individual. And a partnership could be run by over two, including two people, right? So the owner could be two or more people. And a corporation could be run by one person, could be run by 100 person, or it could be owned by thousands or even millions of people. So like Apple, it is a corporation. Their products, iPhones and iPad and Mac and stuff. The thing is, who are the owners of the corporation? The millions of shareholders. Whoever purchased Apple's stock would be the corporate owners. Okay, the thing is, a corporation can also have only one owner, just like a sole proprietorship. But for partnership, it has to be over one owner. For your chapter 14, which I will cover later, it talks about how a partnership distribute the ownerships. And in terms of the taxes, for partnership and a partnership, they do not get a business tax. They do not pay corporate tax. But for corporations, they pay corporate tax. Does that mean partnership and partnership do not pay tax at all? No. The partnership and the partnership actually pay income tax. And I cannot say that income tax at a percentage rate is always lower than corporate tax. In certain level of income, the income tax rate could be higher than the corporate tax rate. But what is better for this kind of two businesses is that they pay only one tax. It's called a single taxation. Whereas for corporations, they pay two taxes, not just a corporate tax, but also income tax. And the income tax for corporate owners is a little bit different, but it's still a significant amount. The income tax is reflected in dividend tax and a capital gain tax, other than the regular paycheck salary tax. And then the next dimension I want to compare here is a limited liability. And for partnership and a partnership, these ones have unlimited liability. So limited liability is defined as your liability in this business is limited to your investments and the assets level of the business. Let's say if you're running a $1 firm and you have a $1 debt, let's say you have a $2 debt. If it is a limited liability, you just need to pay $1 of the assets of the company, because that's the total worth of your company. Although your company's liability is $2, you owe your debt holders $2, but you're only responsible for $1 of the $2 liability. That's called a limited liability. So that more applied to a corporation and also to the LLCs and LLPs that has limited liabilities. But for regular partnership and partnership, there's no limited liability, or we can call it unlimited liability. So back to our example, you're running a company that has only $1, but you have liabilities of $2. So not only you have to sell your company and get the $1 to pay the $2 debt, and you still have to be responsible for the rest of the debt. So $2 debt, after you pay $1, you still got a $1 debt left. So that means you still have to pay that rest of the dollar. So what do you do then? You would either need to sell your personal belongings, you sell your BMW, you sell your house, you may live on the street just to satisfy the debt bill. That is called unlimited liability. And are these major business entities in the United States? Yes. So you will need to file at your city for the business license, and you will be recognized as a legitimate business. And on the legal aspect, the corporation is treated as a legal entity. But for partnership and partnership, it's more like treated as individuals. But for corporations, it is very hard to establish on the legal side. You have to go through all the criteria in corporate law, and the corporate law book could be this thick. And you probably have to hire a team of attorneys or even a number of law firms to establish corporation. But to establish a partnership and partnership is relatively much easier. For example, I can just go to my city in Illinois and just fill a form. It just take about 2 hours to get my business license. That's for partnership and partnership. But for corporation, it's way harder to establish to finish all the legal paperwork. And in terms of a limited life, when the owner of a partnership dies, then the business die with it. And for partnership, also, when the partners cease to collaborate and quit, then the partnership would be gone. So they have limited lives. But for corporations, just because the shares of a corporation could be transferred, and for public companies, the shares could be transferred easily in the stock market. So when you buy a company's stock, you basically have the share. And the share can be transferred to a new generation of investors and then to the next generation of investors. So the corporation just cannot die from this aspect. The only situation a corporation can die is that it fell bankrupt. It's a bad operation. It just keep losing money. But it just does not die because certain owners of the corporation fails or quit, or certain managers of the corporation fail or died or quit. So that's the major aspects for the business entities. Once again, the business entities include actually four: partnership, and a corporation. And the fourth one is limited liability company or limited liability partnership. So the limited liability company or partnership is just the same as these two. The only difference is that they have limited liabilities. Okay, so it's a upgraded version for a partnership and a partnership from the liability aspect.